Welcome to this episode number 43 of your next trade called today Call Us Bond. First thing first, if you like what you see, please subscribe to the channel or put some comments or put a like, and that will be very helpful. So let's look at what has been the week. So as we flagged up last weekend, so that was on Saturday, like 5 hours after the attacks on Israel, which has been unfortunately very much driven the market, and the feelings have been running high. As well, if we look at the market, what has been very much driven across asset classes have been the bonds. So I would like to start with one of the graphs that I've been using over the last couple of months, which is looking at the S&P futures, which in this chart are in blue, versus the US 10 years, which will be in white, and we are talking about the futures. And as you can see here, there is a strong correlation between the two. Very much the move in the bonds, which we are, if we look here at the 10 years, where we were at 3.3% 6 months ago, and now we are at 4.6, 4.7, 4.8% roughly. And that has been creating a lot of waves across asset classes. And pretty much what has been happening recently is the rise in yields, the selling off of bonds, where we went from 430 in the US 10 years to 480, has been creating some pressure on stocks. And this week has been more or less the same. So if we look at the week-to-date asset performance, starting on the left-hand side with the stocks here. So that would be for the stocks. We can see that stocks have been flattish, both for the S&P and the Nasdaq. But there is a bit of two phases in the market between Monday to Thursday, and Thursday and Friday, where we see the market more weakening after a bond auction on Thursday. So market pretty flattish in the US. If we look at the US dollar, strengthening of the US dollar due to a risk off. When the market is in a risk off phase, very often you'll see market participants going after the dollar. Bitcoin weakish, crypto weakish. Interestingly, we have the gold and the WTI. So starting with the gold. So gold has been outperforming quite a lot from Thursday onwards. So Friday we had a very strong week. We're going to be looking at it later, where gold went from 1850 to 1930 very, very quickly in the afternoon. And that tells you market participants are really looking at a risk off. So we had a lot of assets that move into the risk off phase. Obviously, you don't want to go into the weekend long risky assets, which what is happening in Israel and Palestine, and obviously that creates tension not only in the Middle East but across the world. So now looking at the week-to-date industry's performance, this is really an interesting one. So if we look at the QQQ and the SPY, so looking at both the Nasdaq and the S&P, again they are flattish but on the week, but you see the strong diversion between the winners and the losers. So left-hand sides obviously are the losers. You see the healthcare, the airlines. So airlines suffered with WTI, suffered with the start of the war, but that is creating tension obviously for WTI and for the traveling. But you see really a strong dispersion between winners and losers. So despite having on a weekly basis a flattish market, and I'm talking stocks, there has been a lot of dispersion, and you can tell across assets, and you could tell more importantly for stocks that some people have been suffering big time, and I would not be surprised to see in the next few weeks more pressure into this dispersion, because if you have not been holding the winners, that has been a struggle. So that's something that we underline, not only us, but it's pretty clear that if you've been trading the market in 2023, that the market is experiencing a very bad market breadth. In other words, if you look at days like Thursday, for instance, the market was very much driven by very few names. So in other words, you will have 20% of the stocks that should be up on the day and 80% that will be down, but because of the strong concentration into a few names, both on the S&P, the Nasdaq, where you're going to have the fabulous 7 plus some other names that are making 30 to 50% of the indexes, the reality, you're going to have a strong dispersion between those winners and those losers. So on the sector performance, looking at the week-to-date sector performance, I'm looking here. So we get the consumer discretionary a bit down, but really the winners were energy, obviously coming with the WTI, utilities as well, which were bouncing from strong sell-off, and real estate, and that goes hand in hand with as well with the US 10 years, which went from 480 to 455, 460. The reason that we flagged last week was not only because the bond market was closed on Monday, but as well when you get a risk off, and after the big move in yields and the sell-off in bonds, you have a flight to safety. The flight to safety makes people buying bonds again, meaning the yields are coming down, and some of the sectors which will be normally benefiting from lower yields like real estate, utilities, have been performing pretty well. Looking at the FOMC expectations or the Fed expectations through the Fed fund rates, so we are at 5.33 these days. I'm interested into what is the peak rate. So the peak rate is at 5.41, expected around February next year, but not that different. So in terms of Fed expectations, the market is more or less saying we are down into hiking more. And I'm interested as well in looking at what's the differential between December 2023, which is here, and the December 2024, which is 539 versus your 469, which is a differential of 0.7. Okay, so in other words, from May to the end of the year, so from May 2024 to December 2024, the market is expected the Fed to cut rates by roughly 3 times 25 bips. Why? Because market participants are expected inflation to come down, and as well probably from the growth from the US slowing a bit. VIX for this week, it's only going to be this chart, but that tells you as well about the risk on, risk off. So that is Monday, Tuesday to until Friday. So first part of the week, we had some volatility compression, which is something that we experience over and over in 2023. Each time then when the volatility goes above 16, 17, 18%, 19% in 1 month, you will see market, many products that will be selling those volatility, and that is true on the weekly basis, on the daily basis. We had a bit of a spike with both the PPI and then on the CPI, but more, you see the spike that started here with the bad auction. So something that we're going to be covering. So on, let's start now actually. So on Thursday, that was 6 p.m. UK, something that we flagged. We say be very careful with the bond auction because you got more and more paper coming into the market, and the market is a bit saturated with paper. And actually at 6 p.m. UK time, it was a 30 years auction, didn't go out that well, and the market didn't like it. So you see the spike in volatility, but more importantly, Friday onwards, you see this big spike from 17 to 19, and it went above the 20%. So that is something to be keeping an eye for the next few days. This is the flight to safety. We are talking bonds, we are talking gold, we are talking volatility through the VIX futures. So now let's move into the technical analysis, as always, starting with the S&P futures, where we are still in this channel that where we managed to bounce from the roughly the 200-day moving average. But you know, the Nasdaq is the same, where we had a bit of week, the start of the week that was strong, and the end of the week not that strong. Interesting one is the Russell 2000, which has been very, very weak over the whole 2023. That started roughly when we had the banking crisis, but it's not getting better. So if we look at the Nasdaq versus the Russell, the Nasdaq has been making new highs. So again, same story as always. The market breadth is really, really poor. So if you've been long the big tech, you've been doing very, very well in 2023. And if you're long the 90% other stocks, you'll be struggling. I'm going to be looking here at the US 10 years, Why? Because, as I said, we are all bond traders, so callers bond, and so we had a big move from the 320 that was not so long ago, 6 months ago, 330, where we consolidated, and then we went very quickly to 480. So there has been a bit of a fight here between 455 and 485, 490. There is a lot of talks about, bear steepening, bull steepening, where I position many. You'll see a lot of noise on social media, on Twitter, on people that will tell you what to do. We have a big fight at this level. The Fed speakers at the start of the week wanted to say, we are probably down in terms of hiking cycle. We're going to stay high for longer. So with what happened in the Middle East, that helped bonds outperforming. But really the question going forward, is how the bonds are going to be behaving. In terms of the winners that keep on winning, so that's the Facebook of this world, the FANG of this world versus the S&P. So until Thursday, we had the same picture as always. You go for the safe haven. I don't know if it's safe haven, but so far this is how the market has been taking the approach for those names. And Friday we see a reversal on all these names. So actually, what was working as long as Thursday started to move and to reverse on Friday. I'm interested into JP Morgan, something that I flagged. I say, obviously JP Morgan is a very important stock and very important company for the US market. So the earnings on Friday were hawkish. So they beat on the revenues, on the EPS. So they beat on the EPS, but if you do a bit of research and you don't need to drill much, actually on the provision side, instead of doing the 2.5 billion, they do 1.2. So 1.2 instead of 2.5, or 1.5 billion difference on the number of shares that they have. That is roughly a 50 cents difference. And guess what? This is why they beat the market. So, but if you believe a bit in technical analysis, this is not a candle that you like to see. Especially when you're closing at the low. So the price action on JP Morgan was good 2 hours after the close, but 2 hours, sorry, after the open, but on the close, this is not a great price action. And I want to believe that there has been a strong deterioration in many of those banking stock. Looking at WTI, so WTI, obviously there is a lot of Middle East, there is a lot of supply and demand, but there is a lot of noise. So I've been saying over the last couple of weeks, I don't know if we're going to be trading in the low 80s or in the low 90s. A lot of volatility. What I can tell you is actually the market depth or the liquidity of the WTI is very, very poor. So if you look at, I think it was Thursday and Friday, we moved by $2 to $3 on the WTI by roughly 1 hour to 90 minutes on barely no volume. So you don't have many liquidity. The reason is the following: each time that the volatility is on the way up, the market makers have a tendency to just up, going back, taking a step aside and not providing the same liquidity. So that is true for the WTI, and that is true for single names. So be extremely careful. You don't trade the market when volatility, implied volatility, is at 13% on the VIX like it was, let's say, a month ago, and when it is now at 18, 19, 20%, because the moves are not the same, but as well the liquidity will be very different. So gold, interesting. So big move, as I said yesterday. So that is the typical risk-off move. Don't read into too much about, supply and demand. This is risk-off. And you could see that on Friday, many market participants said, I'm scared. I'm looking for safe haven, or I'm looking for protection for the weekend because I don't know what's going to happen over the weekend. And they started to bid quite a lot gold. Looking at currency, euro dollar, we do have like a bit of let's say consolidation after a big move down and the weakening of the euro. We have not been making new lows on a weekly basis, which is a positive. Looking at the dollar yen, and we're going to end up with that for the technical analysis, I think everyone is looking at the breakout of the 150. If you look at the Japanese 10 years versus the US 10 years, there is no reason now that the Japanese yen should not weaken even further. So let's go back into what happened this week. So here you can see this is the copy and paste of last weekend. So if you go back into the episode 42, this is exactly what I flagged for the week, what will happen for the weekend. It's not that I'm a rocket science, it's just this is what happened. So we had a lot of CPI, PPI. So looking at the S&P futures, that is for the PPI, that is for the CPI. And actually, both PPI and CPIs were a bit above expectations, but the market reacted hawkish on the news, as if, you know, most of the bad news from the inflation has been priced. But really what the market didn't like is the bond auction. So we had, as I said, this bond auction, which has here, that was the 30 years bond auction, which didn't go very, very well. The reason is the following. You go into the market, you put a lot of supply with yields, and you are crowding out the market. And the primary dealers ended up with a lot of paper. And with that happening, a sell-off in bonds, and you get the follows with the stocks that started to sell off. Then end of the week, as I said, a bit of a sell-off. Actually, if you look at the VIX versus the S&P, the VIX moved a lot. So volatility, implied volatility moved a lot versus the stocks, when the stocks were only down 50 bips to 1%. So something that I've been flagging and I've been discussing quite heavily on the different channels of the community on Discord is volatility has been dampened over the whole year through structured products. This is very unhealthy to me, and I get the feeling that it's not only me, but you know, that the volatility could be on the rise and could be on the rise very quickly. So if you've been trading in January, February 2018, you remember 2018, sorry, you remember this rise in volatility. I'm repeating myself, but as a trader, this is what I'm looking at. Another thing that I want to be flagging is the bonds auction. So go into those websites. You can be making sure that you put on your calendar the same as I'm doing for the catalyst. When are the next bond auctions? Because the market is driven by this. So finally, looking at the gold, the last session, you see this trend, and then suddenly it goes parabolic. The reason is again mostly because of a risk off. You go into the weekend, you don't want to be long crazy assets, you don't know how to hedge yourself. So how do you hedge yourself? Do you want to do with the S&P? It's not that easy, because reality is the S&P is never gonna go, it never goes down, because you know the fabulous 7 are not coming down. If you go with the VIX futures, you know that there is a lot of compression in the VIX futures, so you go into the gold and you get this big move, especially when the gold, if you look on the monthly basis, over the last months, it's just flattish, so underperform a bit. So now looking at the catalyst going into this week, so we will be starting as always with the earnings. So JP Morgan started on Friday, but we got many earnings here. So we got Schwab, we got Netflix, we got tons of names coming. This is not the biggest week, it's going to be the next 2 weeks after, but really this is about earnings. And why I'm interested into earnings, because I'm looking at the implied move of the market. So that will be this column here. That's something, this is about, you know, the straddle on the day. This is something that you can do exactly the same calculation. You don't need to have a Bloomberg. But I'm interested of how the market will be pricing, how the realized volatility on the day of the earnings will be versus implied volatility. Okay, the reason is pretty much the same. Are we going to have a bigger move or lower move than what the market is expected? We started with JP Morgan, and I want to see how the trend, and I want to see the price action of all the stocks that are coming into the market into these earnings. As I just told you, with JP Morgan, the first reaction was pretty good. We are 4% on the day. Then during the session, we started to sell, and we ended up at 1.52%. So not that a strong session. Second one, this is macro, looking at retail sales. So as I've been flagging, even on Discord, I'm still going to have some people are telling me everything is fine. The retail sales. So we know that the US consumer is slowing. We want to see what is the confirmation going from the retail sales. We get some leading indicator like the XRT, like consumer staples, like Walmart, like Costco, that are coming down from pretty high level. So that will be for the macro, looking at the retail sales. This is here. As always, we're going to have a lot of Fed speakers. The big one is obviously Powell on Thursday. And finally, we're going to have the auctions that are here. So we got an auction on Wednesday, 30 billion, 20 years. We got a 22 billion 13 billion on Wednesday and a 22 billion on Thursday. And we got some option expiry. So both the VIX expiry that is here, and we got the option expiry, the monthly expiry, which is on the third Friday of each month. And here, why I'm looking at the futures, when I'm looking at the VIX, so I strongly advise you to go on vixcentral.com. It's a nice website to understand, how the VIX futures are trading and how they could be moving. So here, this is Friday a week ago, and here this is as of yesterday. So you see, we went from 18% to 19%. Okay, so everything has been moving up. So I should have been putting the other way around, but everything has been moving up. You see that here there is a bit of 60 days. So I'm interested a bit into the VIX structure, how the volatility has been played out, because that's going to tell me a lot about going forward if there's going to be more risk coming. My view is the following. What is happening in Israel and Palestine is obviously very not good news, both for people that are living in the region. It's not good for the world, and that brings volatility. That brings a lot of emotions as well. But you can see from this week that at least yesterday we had a bit of a real risk off, not for stocks. Stocks did fine, 50 bips to 1%, but you get a lot of underlying assets that didn't do that well. So I'm interested now into these options and how the VIX expiry, which happens on Wednesday at the open of the US market, and for the option expiry next Friday, and along this week, what are going to be the earnings. So this is it for me for this week. As always, if you are interested into learning, you get the 4x4 video series, which is a very comprehensive step-by-step how to learn and how to trade your own money. I do one-on-one sessions with mentoring, something that I enjoy doing. If you want to join the trading community on Discord, use this link. There is the link below as well. Feel free to join this community. There are roughly three channels that are for free, and there are 20 channels for people that already subscribe to the 4x4 and the mentoring. So be careful out there. Volatility has been on the rise, and I hope you're going to have a good trading week. Bye-bye.